Hi, everyone. I'm bringing you an episode today focused on valuation of software and high growth technology businesses. So, I am going to be starting with a resource from a guy by the name of Jamie Ball. He works at a venture fund called Altimeter. And this is a publication that he does, I believe, on a weekly basis called Clouded Judgment. So, if you're interested, I will leave a link in the description. He includes a lot of great financial data here, but it is certainly not the only area you can find these resources. Today, I'm going to be focusing on two names in particular when I discuss software and broader technology valuations, most notably Snowflake and Palantir, which are both trading in the top 10 of next 12-month revenue multiples relative to their selective peer group. So, starting with this chart surrounding the top 10, what I really want to focus on today when I speak about valuation is that valuation is relative. It's not a static number, it is dynamic, it's changing, it's fluid, and it is always relative to the state of the market, the state of certain industries, how the business is doing relative to other industries in the space. There's no one correct answer. But you can certainly do quite a bit more work to give yourself a better sense of what the valuation should be and whether or not your valuation is reasonable relative to the risk profile of the company. As you can see, Snowflake and Palantir don't just trade within the top 10 of software multiples on a next 12-month revenue basis. They're actually two of the top three. So, how are software companies generally valued? They're generally valued as a multiple of their revenue because most of them aren't profitable. You can't really assign a multiple or a reliable multiple to companies that are not free cash flow positive or earnings positive. As you can see here, this has actually meaningfully changed over the last 18 to 24 months as technology companies and software companies in particular have come under quite a bit of pressure with rising interest rates. 9 of the top 10 companies in this list are actually free cash flow positive. Granted, there's not a lot of predictability in this free cash flow generation on a go forward basis, but it can show you that these are the companies that are generally fetching premiums as it relates to software multiples in the market. Today, I'm really going to focus around the next 12-month revenue multiple and the last 12-month revenue multiple, since those are generally what I think are the best ways to quickly filter through software multiples and whether or not I believe that companies like Snowflake and Palantir in particular are fairly valued. Okay, so taking a look at Snowflake and Palantir, they are obviously trading at the highest end of their respective peer groups at 14.5x and 15.5x, respectively, on a next 12-month revenue basis. So I am going to show you a series of charts surrounding the state of the cloud software industry to give you a better sense of what these valuations look like relative to the rest of the market, really. So focusing on this chart first, this gives you an idea of where next 12-month revenue multiples have trended dating back to 2015. And as you can see, the long-term average is actually 7.8. And the highs back in 2021, some of 2020, that ultimately led to the meaningful sell-off that we've experienced over the last 18 months within software are really a direct result of rapidly rising interest rates combined with investor overexuberance surrounding software businesses over the last few years. So again, you can see that the long-term average was 7.8. We were trending at 15 to 20x, not just for the top software companies, but for all software companies in the industry, really demonstrating how hot and overheated the market became. Granted, we've now likely from a long-term perspective oversold, now trading at close to 5x on a median basis, but I wouldn't necessarily expect this to rapidly expand towards 7.8 in this environment because you're basically underwriting to multiple expansion in a rising interest rate or high interest rate environment. And I'm not necessarily sure that it's prudent to underwrite to expansion of multiples when you're looking at high growth and at least the top end of this peer group. Transitioning over to this next chart, this just demonstrates the premium that the top 5 software companies measured by the next 12-month median have traded relative to the broader median within this respective market. Of late, this has looked like a 14.5x NTM revenue multiple relative to the 5x. And really the point here that I want to get across that I'm going to apply to Palantir and Snowflake, or at least hold them to, is that while when you're looking at the top end of this peer group, the growth rates and the returns from an investment perspective can certainly accelerate and generate well in excess of the broader median, they can also fall much quicker. So long story short, the expectations are much higher. And when those expectations aren't met, the fall can be that much greater. Transitioning over to the broader breakout on the data on last 12-month and next 12-month revenue multiples, you can see that Snowflake is traded close to 19.7x, while Palantir is traded close to 17.3x. And I just want you to remember those two numbers, call it 17 to 20, for when we go over to our next database looking at some of the valuations relative to historical highs and the state of the market. And then long story short, just concluding here, you can see that for the 90th percentile, which is where I would put, obviously above that, but the 90th percentile where I'd put Palantir and Snowflake, the last 12-month revenue multiples have largely traded around 15x, and 12x on a respective basis. Transitioning over to the valuation charts here, showing how the multiples of Snowflake and Palantir have trended over the last few years. You can see in the instance of Snowflake, they have pretty dramatically plummeted from their revenue multiple of 107x, so call it over 100x in yesteryear's market, all the way down to sub 20x in this environment. Really just demonstrating the meaningful sell-off that they've had over the last few years and potentially the opportunity with some of these software companies. However, when looking at the sort of return profiles that you need to hit for a company like this, and by the way, this software is called Fast Graphs. It's something I really enjoy for visualizing valuations and kind of playing around with different multiples and scenarios to kind of get a sense of the annualized return that I would hit in certain outcomes. I can leave a link in the description. It is paid, but one that I really enjoy. But transitioning over to analyst estimates and some of the return expectations I would have around a company like Snowflake, they need to hit pretty aggressive top line growth targets. So on these last few years, I'm not going to assume that they're growing at 67%. That's pretty aggressive. I'll just call it 20%. And then use analyst expectations over the next few years. So looking at this scenario, which I think is candidly like a really good scenario for this company, this is certainly not a base case. This is not a downside scenario. You can see at their current levels, if you expect that they'll get back to the 74x revenue multiple ranges, that would be a 59% annualized return. That is completely unrealistic, and where many investors go wrong when looking at high growth software companies once they've traded from their highs. They just think that, oh, okay, great, this company has traded off 30%. They're sure to get back to their previous highs. This is an obvious buy. What we need to do here is we basically need to reset the benchmark in line with the rest of the software industry. So as you can remember, Palantir and Snowflake were trading at 17 to 20x on a trailing 12-month basis, 17 to 20x revenue. But that was still high, and I wouldn't underwrite to that. I would underwrite to a lower multiple, even 15x, which is just the broader top 90%. Even that could be aggressive, but I think it's a good way to visualize the return expectations for a company that I think could reasonably grow top line revenue at 25% year over the next 5 years or so, especially considering the interest in AI and the implications for companies like Snowflake, obviously Palantir as well. So looking at this updated chart, you can see that if I were to expect Snowflake to grow to 25 or 24.5% annualized top line basis, that at a 15x multiple, you'd be expecting a 16.8% annualized return over the next 5 years or so, which is fantastic. That's incredible. That's exactly what you want as an investor. That largely outperforms the market. The key here, though, is that if they don't hit these expectations, they will largely take a hit from a multiple perspective. So as you can recall, the median was much lower than this. So if they're not hitting these high growth expectations, you could expect that they would fall around, even 10x to 12x maybe from an annualized return perspective. At that range, all of a sudden, this looks like an okay investment, not a phenomenal investment. If you consider the historical returns of the S&P 500, getting close to 12% for something like Snowflake is fine, but that's not a guaranteed outperform the market sort of return, and it's certainly not the return that you're expecting for a company that's trading at such a premium and technically contains quite a bit of risk relative to the rest of the market, given they're not consistently profitable and there are many unknowns with regard to competition from private companies like Databricks and others that are trying to eat their lunch. So the point being, Snowflake could be a phenomenal investment here, but it matters what multiples you're underwriting to and the growth expectations. And the higher the growth expectations, the more possibility there is that if they miss those expectations, the ultimate multiple will take a hit in the long run. Okay, so concluding on Palantir here, you can see a similar story as Snowflake, obviously not reaching some of the highs that Snowflake did, but obviously trading well in excess of what the rest of the software market was doing at a 38x multiple, and then dropping as low as close to 6x revenue, and now actually making its way close to 20x over the last week or so. So how would I think about the valuation of a company like Palantir? Again, let's go back to the growth estimates. Let's look at analyst estimates over the next few years. And again, I'm not going to underwrite to anything like 60x. Let's say 20x to be consistent here. I think Palantir has quite a few tailwinds. Do I think that they could achieve a near 20x annualized return on a top line basis? Sure, I don't think that's unreasonable. But again, we don't want to underwrite to the base case multiple of 22 to 23x. We don't want to reset this to something like 15x. And 15x, again, is not conservative. That is a good multiple for a company like this to be trading at. And another thing to remember for companies like Palantir and Snowflake is that as they transition to having more predictable cash flows and hopefully positive earnings, they will be valued on a multiple of their earnings. And the multiple of revenue will become less and less important as you're evaluating the growth prospects of these companies. But granted, they're in very much of their growth phases. So evaluating them on a top line basis, and given their lack of consistent profitability, is still the best way to evaluate them on a quick valuation basis relative to the rest of their peers. So looking at something like Palantir, you can see that because they're trading close to 20x revenue right now, if they were to grow at a 20% annualized top line basis over the next 5 years, you would need them to maintain a 18 to near 20x multiple to achieve a really solid return basis. And when I say really solid, I mean like a decent margin in return, outperforming the S&P 500. If they were to return to normalcy in something around 15x, you're talking a 13.2% annualized return, which is still good. That's likely to outperform the market, but not by a broad basis. And that's also assuming that they're executing to plan and hitting their forecasts, which again are going to be quite aggressive given the expectations of a company like Palantir. If they don't hit those expectations, you're talking a company that could fall even to the 10x revenue range. And in those instances, you are looking at annualized returns of 5.65%. And that's not what you're looking for a company like Palantir. Do I think that that's going to happen? I don't. But do I think that now is the best time to be buying Palantir? I don't. I think that there are more reasonable times to be investing in this company. If you had invested at Palantir at 6x revenue, you would have already received a meaningful gain on your investment as the multiple expanded, over 2x just in a matter of 12 months, I guess. So the point here is that your entry point really, really matters with companies like this. And just because you see people on Twitter, on the internet saying, oh, Palantir is going to the moon, hold forever, it doesn't mean that you're investing at the best time. Generally, when people are over exuberant about companies like Palantir, like Snowflake, there is plenty of room to fall as well. So point here is that be careful when you're entering. Make sure you're looking at valuation from a holistic perspective and on a relative basis, very critically, a relative basis. The lower the valuation multiple you're getting in at, all things equal, the more downside protection you have, considering that valuations have much more to fall the higher the multiple they're trading at as a relative to whatever metric that they generally are measured by. So, in the instance of Palantir and Snowflake, I think Snowflake is interesting levels, still not a range where I think it's a no-brainer buy. Palantir has traded beyond where I'd be comfortable buying personally, but something to keep an eye out for. So thank you all for listening. Still trying to get better at this podcasting format. And I'd appreciate any feedback that you might have. And if you want me to go through any other companies, any other valuation analyses, please let me know. Happy to incorporate any feedback and trying to give you guys a little bit more of what you're looking for. So otherwise, thanks for watching, and hope you guys have a great day.